We're going to cover what an offset account actually is, what a redraw facility is, the key differences between them, how to use each of them strategically, and how extra repayments can save you time and money over the life of your loan. Hello, and welcome to First Home Unlocked, the podcast for unlocking clarity and confidence for first home buyers. I'm Jack Elliott, National First Home Buyer Specialist at Alcove.
And I'm Chris Bates, ex-financial planner and mortgage broker.
Together, we are on a mission to empower you with the keys to unlock your first home. Let's jump in. Welcome back to First Home Unlocked. How are you today, Chris? What's news with you?
Doing well, Jack. It's had an awesome break up the north coast of New South Wales. Spent a bit of time in Foster and Coffs and Yamba camping with mates and fully recharged and refreshed. How you been?
Yeah, good. Had a nice break as well. Spent some time up in Echuca with some family and then back down to Geelong. The weather didn't really turn it on, but it was still good just to chill out, go to the beach when we could. Yeah, we're going to start today where we're unpacking offset, redraw, and the power of extra repayments. And I'm really looking forward to getting into this one because it's a question I get with first home buyer clients very often. So if you listen to our episode 21, Unlocking How a Mortgage Actually Works, we talked about how interest is calculated daily in that episode. So that means even the small changes to how you use your loan features can make a huge difference to what you pay back over time. Now, offset and redraw both help you reduce interest, but they do work differently in the background, which can affect your flexibility later on, especially if your home ever becomes an investment property. So today we're going to break it all down. We're going to cover what an offset account actually is, what a redraw facility is, the key differences between them, how to use each of them strategically, and how extra repayments can save you time and money over the life of your loan. Now, Chris, to kick us off, why do you think understanding offset and redraw is so important for first home buyers?
Yeah, there's a lot of misunderstanding around offset accounts. And, once you really understand how it works and how it offsets interests and, and the flexibility and the options it gives you, you're like, hang on a sec, this is amazing. And I think that's where a lot of why you need to really try to understand it is that once you understand it, it's a huge benefit to use it for particularly a lot of first home buyers. And I think it's exciting to do this episode because I do spend a lot of time over the years educating clients on offset accounts. And once they get it, they really do see the benefit.
So let's start with offset accounts then. So an offset account is just a normal everyday bank account that's linked to your home loan. So you can have your income paid into it, you can tap your card, pay bills, and move money around like any other transaction account. But how it's different from your everyday account is that it's linked to your home loan in the background, and this helps you reduce the interest you pay on your loan. So each day the bank looks at two numbers, how much you still owe on your loan and how much money is sitting in your offset account. And then they take your loan amount minus whatever is sitting in your offset and only charge interest on what's left. So for example, let's just say you had a loan of $800,000 and you had $50,000 in your offset account. The bank will only charge interest on $750,000. So you're not earning interest like you would in a savings account. Instead, you're reducing the interest on your home loan. So like we mentioned, interest is calculated daily and then it's charged monthly. So this means every single day that money sits in your offset has an impact. And the more days your offset balance is high, the more interest you avoid paying. And this is why having your salary paid straight into your offset and then spending from it over the month can make a real difference over time. Now, one common misconception is that if you have money in your offset, your minimum home loan repayment will drop. But your repayment actually stays the same regardless of what's in your offset account. What does change though is how the repayment is split between interest and principal. So by having money in your offset, less of your repayment is going towards paying back interest and more of your repayment is actually paying down the principal, or in other words, reducing the loan balance. So you get ahead on your loan faster, even though the repayment amount looks the same in your banking app. So let's walk through some examples showing the impact of your offset account. So let's say you had an $800,000 property that you bought, you used the 5% deposit schemes. So this would leave you with a loan amount of $760,000. Now, let's say you had an interest rate of 5.45%. That means your minimum monthly repayment would be $4,291. Now, if you made no extra repayments at all and had no savings in your offset account, Let's assume for the sake of this example that the interest rate never changed. You would pay back around $785,000 in interest over 30 years on top of your original loan amount of $760,000. Now, let's look at what happens when you put your emergency fund, for example, in your offset account. So if you held $20,000 in your offset for the life of the loan, your total interest would drop by around $77,000 and you'd save roughly 1.5 years of paying your loan back. Now, if you up that and held $30,000 in your offset for the life of the loan, the interest you save increases to around $112,000 and you'd pay back the loan about 2 years sooner. And then if you kept $50,000, say, sitting in your offset for the life of the loan, your interest reduces by around $177,000 and you repay the loan roughly 3.5 years earlier. And this is without changing your budget or making any extra repayments. You're simply letting your savings sit in the right place in your offset so they work for you every single day. What do you think, Chris? Anything you want to add about offsets?
So the first thing I think with offset accounts is that a lot of people just genuinely misunderstand that it's not paying your loan off each month. I think that a lot of people think, oh, hang on a sec, that, my repayment's still the same. There's not a real benefit. And I think what you need to do is really go and look at, well, how fast is your loan actually now reducing? It was reducing, say, $1,000 a month prior, but now that I've got $50,000 in my offset account, it's reducing $1,200 a month. And you can start to, once you flip it and you actually go and do that calculation, you can really understand that, hey, actually, while my repayment's the same, my loan is reducing faster. And the reason is because more of my repayments paying the loan off versus paying interest. And I feel like you've got to go and look at this sort of bank statement and the home loan statement to actually go, oh, I get it now. Okay. Because it's really confusing when you see the repayment number stays the same. You think, hang on a sec, this isn't working. The offset account isn't saving me money. But then when you look at how fast the loan's coming down, you're like, it's actually paying off faster now. That's one of the things I think sometimes we have to re-educate clients on it when they do look at it and sometimes forget the benefit of an offset account.
Yeah, and Chris, that's really important to understand. And last year there was a bit of news around offset accounts not being linked at some of the major banks. Now, what are your thoughts around this, and what can first home buyers do to make sure they are linked?
Look, this can be an issue. It happens in your loan application, it happens in your loan docs. Like I think sometimes, when brokers are lodging this, and even banks, to be honest, the amount of clients I've seen that have come to us years down the line, they've never had their offset account linked and they were at a bank and a bank teller, employee did it. So it is common where people haven't had their offset account linked properly. And so it's one of the things you definitely want to check after your loan settles and make sure that they're connected. You can call the bank. You could, the broker should also be able to call the bank. And we actually check with our clients. And in fairness, I actually made this mistake a few times in my first year or two of broking is, there's a lot to do as a solo operator. And it's quite expensive for our clients. And, we've had to sort of pay things for clients when it's our issues. Banks have had to step in when it's their problem. And I think that's one of the housekeeping things when you settle a loan, just make sure your offset account is linked. If it was a bank error, often they'll just fix it up, right? They'll go, hey, and they'll recalculate your interest. But if it's something that you maybe should have done or a broker should be done, that's a real issue. So just be really careful with that.
Yeah, and like you said, Chris, it's all about checking. We definitely do check with every client in our process because there has been them issues in the past, and just making sure that they are linked after that settlement is really important. Now, just so you're aware, to have access to an offset account, most lenders charge an annual package fee, which is usually around $395 per year. But the benefits of using your offset will far outweigh that cost in most cases as well. So now moving on to Redraw, which is similar to an offset account. It also helps reduce the interest that you pay on your loan, but Redraw works differently in the background. Now, Redraw is not a separate account with its own BSB and account number. It lives inside of your home loan. So what happens is you make your normal minimum repayments each month, and on top of that, you choose to make an extra repayment into the loan. Now, when you pay more than your minimum repayment, your loan balance drops below where it needs to be according to the minimum repayment schedule. And the bank counts that as an extra amount as your redraw. So if your original loan, say, was $800,000, and over time you've paid it down to $750,000, but based on the minimum repayment schedule, you only needed to be at 770,000. That means along the way, you've paid an extra $20,000 into the loan above your minimum repayments. Now, this extra $20,000 you've paid is what's available in your redraw. So when you get up your banking app, you might see your loan balance at 750,000, and underneath it'll say available redraw 20,000. And while that extra money is sitting inside the loan as redraw, you're not paying interest on it. Now, where redraw really feels different to offset is how you get your money back out. With offset, you can spend directly from that account, but with redraw, you usually need to transfer money out of the loan and back into your everyday account before you can use it. Now, most of the time this is simple, but there are some important considerations to be aware of depending on the lender and the loan. Because some redraws are instant and available within the app, some have minimum redraw amounts, and some have daily limits on how much you can actually redraw. And if you've missed repayments, entered hardship arrangement, or the bank has changed its redraw policy, your access can be limited or delayed. So we've also seen examples in the past where banks have changed redraw rules during times of economic stress, and customers who thought they could access their redraw lost access to their extra repayments, or the rules around how much they could redraw were changed. But in saying that, these decisions were eventually overturned by the banks. But it's a good reminder that redraw is a part of the loan contract, so ultimately the bank controls the rules around it. Now, Chris, I know you've seen the real examples of banks changing redraw access in the past. What actually happened there, and what should first home buyers take away from these situations?
Look, I think we've been, I could probably bring up a post from 2016 or 18 and, selling the benefits of offset accounts and, why you should really look to use them. I think one of the issues sometimes people find it's just a behavioral thing, which I think we'll go into detail before, but we've always been a huge, advocate of offset accounts. And one of the reasons why is because we just didn't trust banks with redraw. And we know that it's much easier just to access your offset accounts in a savings account that's linked to your loan. It's not like part of your loan. It's like extra cash. So it's just offsetting your loan, and you got full flexibility and liquidity, and it's just much better protected. It's actually savings. And I think with redraws, we just know that there's rules around it, and that rules change at different banks, but also they could potentially change those rules. Now, when ME Bank did it, absolutely. CBA did some stuff as well. And that kind of proved that these things could happen. You're right, they got overturned, but that didn't change the fact that they even tried the banks. And it just was a bit of a canary in the coal mine that you've got to be careful and potentially using redraw when you have got the benefit of using offset accounts.
Yeah, and I think you're right there, Chris. It's all about just being careful. At the end of the day, the banks control the redraw. So that's just the risk you've got to understand with redraw compared to offset as well. So now that we've explained offsets and redraws separately, let's talk about the key differences from a property strategy point of view. So like we've talked about, both offset and redraw reduce the amount of interest that you pay that can help you save money and time in paying off your loan. But the structural differences are important, especially when we talk about tax, behavior, and future plans. So let's break down some strategic considerations. Now, first is the tax side of things. Now, I want to be clear. As mortgage brokers, we can't give you tax advice. What we can do is explain how these loan features work from a structural perspective and highlight the tax considerations you should discuss with your tax accountant. Now, one of the biggest long-term differences between offset and redraw can come up if your property later becomes an investment property. Now, as a general rule, the interest on a home loan is not tax deductible while you're living in that home. Now, if the property later becomes income producing by receiving rental income, interest on the loan may become deductible. Now, the key factor that ATO generally considers is what the borrowed money was used for. Now, with an offset account, your savings sits in a separate linked account. You reduce the interest that's charged, but the loan balance itself does not change. With redraw, when you make additional repayments, you reduce the loan balance. If you later withdraw the funds and use them for personal purposes, that portion of the loan may be treated as private debt for tax purposes. Now, that can affect how interest is treated into the future. So if there's any realistic chance that your first home might become an investment down the track, the tax implications of offset versus redraw could be very different. And this is exactly the type of scenario where speaking with a tax accountant is really valuable. The tax treatment can become quite specific depending on how the funds are used. Chris, what do you think? Anything else you want to add here?
Look, I think this is one thing that, if I go back maybe 10 years ago, it was a real um, desire for a lot of people who maybe they bought themselves a little apartment. They were just, maybe they had a guarantor loan was very common back then. And they said, well, this is just going to be, maybe our starting property. And we absolutely want to try to keep it long term. And borrowing capacity was a lot higher. Prices were a lot cheaper. And that they were going to use it as a stepping stone into something else. So it was a city pad now, but then they were going to move to, just outside the city, and we're going to try to buy a house, and they wanted to keep their first apartment. And the amount of clients I saw that came to us, as the years went on, that just hadn't set their loan up the right ways, the ability to keep their first property was really minimal because they'd paid that loan down. They'd done the right thing. They, first time buyer, got a property, they try to pay it off as fast as their property. They didn't understand the tax consequence of really a very low tax deductible debt on that now investment property and a very high non-deductible debt on the home. And so, yeah, it really can be the difference between the ability to keep a property or having to sell a property. And so if there's a chance that potentially you're going to use this as a bit of a stepping stone and keep it, really try to make sure you maximize your investment deductibility on your debt by setting it up the right way.
Now, you mentioned it before, Chris. Money psychology is really big when you talk offset redraw, and it's also really important when it comes to the strategy around them. Now, offset tends to work best for people who can look at their account balance without feeling the urge to spend it. And if you already use a bucket styling budget system where you have buckets for bills, savings, and buffers, using a lender with multiple offset accounts can work really well. Now, this is because the bucket still helps to reduce your interest while keeping your money organized. Now, if you want the flexibility to move money quickly as life changes, offset can be really helpful. Redraw, on the other hand, can be a better fit for someone who prefers to keep their extra money at arm's length. So if you know you're the type who will spend whatever is sitting in your bank accounts, putting extra into redraw can create that buffer needed, as there are extra steps involved to gain access to that money. And also, because it's sitting inside the loan and the balance looks lower, people often feel less tempted to touch it. Taking it back out can sometimes feel like you're undoing all your hard work. Now, for many first home buyers, a combination works really well. You might keep your emergency fund in your offset where you can reach it easily, and then pay any extra surplus into your redraw to reduce the temptation to spend it and keep yourself on track. Chris, how should first home buyers think about their own money habits when deciding between offset and redraw?
Yeah, I do think this is a good point, Jack. And I think, you don't have to sort of, always keep it as an offset account. But if you sort of start off and you go, hang on a sec, we're finding it really hard to just get on top of our mortgage because we just keep on spending the money in the offset account. There's nothing wrong with sort of putting a flag up and saying, hey, I want to switch to redraw, or vice versa. You go, look, yeah, we're really on top of this, and I don't think we'd have any issues. We've got into a good flow here as a redraw. There's no issues with potentially changing that loan to offset in the future. That's the first thing. But I think it's also just being, real with your own sort of money sort of behavior. And it's real. I do think that's one of the big negatives of offset accounts is the money can sit there. And unless you're really strict on what you spend, often that just having that money sitting there, particularly if it's a large balance, can be really tempting. What I personally do though, however, is try to break up where you do your loan and where you do your day-to-day spending at different banks. I think this is another way to manage that. So, instead of seeing an offset account there at a certain amount, what you would do is you'd transfer an amount that you live on per week or per month or fortnight at a different bank so you just don't see your offset account. And that's another way to still get the benefits of an offset, but also protect yourself from the risks of just always spending the money in the offset account because you see it and you log into your internet banking.
Yeah, that's a really great point, Chris. And like you said, the key takeaway here is there's no single structure that suits everyone. The right setup really comes down to how you operate day to day. And you want to match your loan features to things like how you manage your money, whether your first home could become an investment later on, how important flexibility and quick access to cash is for your situation, and how you behave when money is sitting in your account. All right, so now that we've covered offset and redraw, let's talk about the power of making extra repayments, because even small amounts can make a big difference over the life of a 30-year loan. Now, let's use the same example as before. You've purchased for $800,000 using the 5% deposit scheme, so your loan balance starts at $760,000. Let's assume your interest rate again is 5.45%, which means your minimum monthly repayment is $4,291. Now, if you made no extra repayments and rates stayed the same and you didn't use an offset, again, you'd pay close to $785,000 in interest over 30 years on top of your original loan amount of $760,000. Now, let's break down what happens if you're able to make extra repayments. For these examples, to keep it simple, there are no funds sitting in your offset account. So if you contributed an extra $100 per month or $25 per week for the life of the loan, your interest would reduce by about $51,000, helping you pay off the loan roughly 1.5 years sooner. Now, an extra $200 per month or $50 per week for the life of the loan, you'd save around $95,000 in interest and shorten your loan by about 3 years. Now, if you can pay an extra $400 per month or $100 per week for the life of the loan, you'd save around $167,000 in interest and you would pay off your mortgage about 5.5 years earlier. So as you can see, whatever amount you can comfortably put towards your loan, even small, consistent amounts, can make a huge difference over time. Now, I just wanted to mention also that if the money you're using for extra repayments is the same money that would have sat in your offset account anyway, there's no additional benefit to making that extra repayment. This is only true if the money would have stayed in your offset account for the life of the loan. Now, Chris, when do you think it makes sense for first home buyers to be making extra repayments?
Look, I think in the day and age of 2026, it's really hard for first-time buyers to make that next leap from let's say it's an apartment to a house, or a smaller house to a bigger house, and we're starting later on first homes, etc. So, regardless if it's your sort of home and you want to renovate it one day, then trying to build as much equity as you possibly can, because property might go up, and also it can go up the amount of equity you've got because you pay your loan down. And so I do think, naturally when you come out of buying your first home, often you go to this danger zone and, it's not over yet. You've sort of got a property, but you've just got to sort of try to get as much buffer as you can, and getting on top of your loan as quick as possible, and just rebuilding your emergency fund. Once you're through that, paying off your loan does make a lot of sense because it just gives you more options down the line. You might end up using that money because you might say, it's worth spending 20 grand because I'm going to add $50,000 valuation to the property. But and there's really because it's after tax sort of interest rate, it's hard to justify a lot of other type of investing, like buying shares or, doing other things with that money. Super is a different thing, but, putting that money in your home loan, sort of like a guaranteed return, because it's sort of like, the 5% we are today, it's that after tax, or it's the 4% or the 6% or whatever it might be. So, that's another reason why.
Yeah, and one last thing about extra repayments is they don't need to be consistent forever. So most people go through seasons where they've got some extra pay they can put into their loan in their budget, and other times where things tighten up, and that's completely normal. The key is to take advantage of the times where you do have extra capacity, because even small amounts in those times can compound into huge long-term savings for you. Now, they also build buffers, which you can use later on if life gets busy or more expensive. So to recap today's episode, both offset and redraw help reduce your interest, but they work differently when it comes to flexibility, your money habits, and tax deductibility for investment properties. And even small extra repayments can help you save years off your loan and save you thousands in interest. And if you'd like help choosing the right structure for your situation, you can book a get-to-know-you chat at firsthomeunlocked.com.au/book, or through the link in the show notes. Thank you so much for listening, and we'll see you on the next episode. Thanks, Chris.
Thanks so much, Jack.
Thank you so much for listening. We'd really appreciate if you could do us a huge favor. Share this episode with any first home buyers that you know, so we can help more people like you feel clear, calm, and confident when purchasing their first property. You can join our Facebook group, First Home Unlocked, to continue the conversation with other first home buyers. Or if you're ready to unlock your first home, you can book a get-to-know-you chat by using the link in the show notes, or by going to firsthomeunlocked.com.au. Before we go, just a reminder that everything we share on this podcast is general in nature and not tailored to your personal situation. We always recommend seeking advice from a qualified and experienced professional when making financial decisions.